Thank you all for joining. And we have Mr. Chandrasekhar Kuperi here. Hello, sir.
Sir, a very good evening to all of you.
Your video is not on, I suppose.
Yes.
It is
Mr.
on now.
Anandan, a very good evening to all of you, and a very good evening to all who have joined today. Thank you.
Thank you very much, and thanks for the great session today. And we'll just enter into the session directly. And today's topic is basically on. So we have this digital politics with. I think there's an echo at the back end. Yeah. Uh, so this digital politics with Thedal Anandan is a webinar online series we do bi-weekly on every second Saturday and fourth Saturday. And this is on season 1, episode 3. And the topic is how to get funding for startups by building investors' confidence. And today we have Mr. Chandrasekhar Kuperi from is the founder of Anava Corporate Services. So without further delay, we just enter into the session directly. And there's a QR code. If anybody is not being part of Forum of Digital Politics Community Group, maybe you can scan this QR code and join the group. Okay, now let's time to introduce our chief guest. Mr. Chandrasekhar Kuperi is basically founder of Anova Corporate Private Services Private Limited, and he is also a general partner in Peaceful Progress Fund, which is a Category 1 AIF fund, which basically invests in early stage startups. And he has almost 2 decades of experience in various multinational sectors, such as FMCG, life insurance, audit, and assurance. And he also has a very rich experience in M&A space, merger and acquisition space. Till now, he has done almost 11 acquisition and 4 disinvestment in restructuring and refinancing, both in various countries like North America, various continents like North America, Europe, and India. And being a sector agnostic, Anova completed multiple various assignments in various segments in notable sectors or like disinvestment of Vibgyor paints and chemicals to Nippon paints, and disinvestments of Novokostia Botic Homes to Oyo Rooms, which is one of the famous largest hospitality company. And multiple fundraising is also he has done fundraising for Bellatrix Aerospace from strategic investors. And he also made investment in early stage venture capital funds, including Pi Ventures Fund 2, One Crowd IV Cap, Point One Capital, and Let's Venture. So, without wasting further, I just want to hand over the dais to Chandrasekhar sir. So, if I missed anything about yourself, probably you can just give some 2 to 3 minutes brief about you, sir, before going into the questions.
Thank you so much for that generous introduction. I think you have covered most of it. Just for the sake of transparency, I have 17 years of corporate experience before I became an entrepreneur, which means I think the message which I gained for myself is that I think learning as we are doing is very important in our journey of being a founder or entrepreneur. So I think my experience with ExxonMobil, KPMG, and with Yardley of London, 17 years of work experience has definitely helped me to be where I am today. So I'm grateful for that journey.
Thank you, sir. So, guys, if you have any questions to Mr. Chandrasekhar, you can drop your questions in the chat box over a period of time when we start discussing with him, so that it will be easy for me to ask questions at in between or at the later stage. Audible, guys?
Yes. Mr.
Okay.
Anandan.
Fine. So let us go into the first question, sir. So before approaching any investors, so what are the basic steps that startups should take care of it?
Mr. Anand, that's a very important question, in fact, because as an investor, we are very fond of this particular question. Let me begin by saying that most founders and startups, they always believe, that their idea is superior. They always think their idea is everything. Now, nothing wrong in that, because I always say that ideas never fail. But then the next line in my statement is very important. Ideas never fail, but the business model can fail.
Okay.
All of our ideas are backed by business models. And if we don't revisit our business model to ensure that our business succeeds, then I think, it becomes a bigger issue for the startup. Why am I saying that? I think most founders and startups, to get to the best idea, they need a lot of ideas. And in fact, it is said that all of us get 60,000 thoughts per day, which means there are a lot of, ideas, that we all, keep getting. But the only difference is my idea capable of being converted into a hypothesis? So what is the difference between idea and hypothesis? Because in a startup world, everybody says idea aa gaya. Everybody says an idea. But the point is, can that idea be converted to hypothesis? What is hypothesis? If we can test the idea, it is called hypothesis. Simply put, if I can test the idea, it is called hypothesis. Why am I saying this? I think in the world of startups, the startup need to realize that they have limited time, money, resources. This is Satyam. They have limited time, money, resources. And therefore, if they need to survive and figure out a viable business model, before they run out of this limited time, money, and resource, they have to show their capability. What is that capability? It's called execution. Means what I'm trying to tell you is that it is not in the power of idea success lies. It is in the power of execution. So to your first question, what is the very first step that a startup should look at? I have an idea, but the question is, do I have the greater ability to execute that idea? Because this is what investors are looking at. For example, how do you do that? I'm sure Anandan sir, you would have heard of a concept called design thinking. It's a very old concept. It's not a new concept. But in design thinking, one of the very important steps that we do is we try to understand what the customer wants. We try to understand what the pain point the customer is going through even before we come up with an idea. I'll say that again. In the world of design thinking, the very first thing that we do is we try to understand what the customer wants. What is the pain point the customer is facing? Then only we come with an idea. Then we don't stop there. Once we have come up with an idea, we develop a prototype so that we can test the prototype, because only when you test the prototype, you're going to get feedback from the customer. Your very first question, what are the first steps? You have an idea, convert that idea into hypothesis, ensure that that hypothesis is backed by customer validation.
Okay. So customers should validate or customers should agree for that idea.
Exactly. If customers are able to give a feedback, then it's no more, an idea. The idea has already become a hypothesis. And therefore, from here, you can truly understand what problem the customer is facing. I always say that.
That's right. If customer is agreeing for the idea, why should I go for investor? So I can directly sell my idea and make a business out of it, right? So I don't need investor if customer is already buying it.
So what happens is the customer is buying it, but how do you make your product or service known to much more customers? You need marketing monies.
Right.
You need monies towards hiring the right people. Probably you need monies towards technology. So this is where the capital actually comes in. So I always say that, in your very first journey, please go deeper into the problem, understand what the customer problem is, because a problem well defined is a problem half solved. If you understand the customer problem, that's fantastic.
Great. So there are many types of funding available in the market. People are saying bootstrapping, invest on our own, or there are angel investors and the venture capitals, and there are some government grants also, like the Startup TN in Tamil Nadu, even in Startup India at India level is giving some grants. So what are the other types of? So is there any other type which I missed, or how different each kind of funding is?
The funding is dependent, on the stage of the business.
Okay.
Also on the capability of the founder. I'm sure, Mr. Anandan, you will realize that there are a lot of smart founders who are able to raise money just like that.
Yes.
Not possible by everybody, but by some. So I think it depends on the stage of the business. It depends on the capability of the founder to raise the money. But let's understand what are these terms. What is bootstrapping? It's my own money. The monies, that I have raised from friends and family, which is what I'm using, to run that startup, so that the startup is able to show certain scale before I approach external people. My own friends, my own family, they'll always trust me. If I want money, they'll simply bet on me saying that, okay, take the money, run the startup. We'll see, when the money needs to be returned. So this is bootstrapping, which means my money or my friends and family, I'm using that to run the startup. But after some time, you need more monies for scaling up, for growth.
Right.
What do? You have to go outside to either borrow it as a debt or borrow it as an equity or take the money as an equity. So when you take the money as an equity, this is where the other terms, that I see on the slide here comes in. So you've got this angel investment. Who is an angel? Angel is people like you and me who probably have, enough net worth so that they're able to use some net worth towards the startup world. They would have invested in real estate. They would have put their money in mutual funds, probably in listed companies, probably in gold, property and all that, but also some money towards unlisted entities, which is called the startup. So they are angels. They are able to put some money out there. Okay. But then if you need sizable money from angels, you go to something called venture capital. What is a venture capital? Venture capital is actually an institution. So it is a corporate body which is raising money from different people or from different other corporates or from different other institutions so that they are able to put the money into the startup. So the term bootstrapping, angel, venture capital, or let's say, the grants that the government itself, is able to give, or let's say the accelerators, who are able to also put money into the startup, depends clearly on the stage of the startup and also the ability of the founder in terms of how well they're able to raise the money.
Okay, great, sir. Sir, see, I have an idea and I want to create a big empire out of that. As you said, the idea is needs to be validated by customer, right? I agree, fine. But even I feel that idea is validated and it has a market potential. So, but how do I define the funding structures? As I don't have much orders, I'm at a very early stage, just at the idea stage. Even we see many people raising funds at the idea level, saying that this millions of money has been raised, so many billions of money has been raised. So how do I determine how much money I really require for my startup?
This fundraising is large art and less science.
Science.
So when you say art and science, it is large of art and less of science. Why am I saying this? I think if a founder is being asked a question, are you ready to raise money? The founder should not accept that question. In fact, the founder should be able to, repeat the question differently by saying, am I ready to grow my startup? Only when in the mind you have realized that there is growth, then I think, this raising money should come into your equation. Because when you raise money from your friends and family or your own sources, the whole idea is to come to that survival mode. How do I survive? I've just started something. How do I survive? When you want capital from the outside world, you're not looking for survival. You're looking for growth. What is the bigger message I'm giving here? The bigger message is you're choosing a partner. Whoever is putting money into the startup becomes part and parcel of the startup, which means it's like a marriage. Once you have brought a funder into the startup, it's like, both have to run the startup effectively, which means the person who is funding the money is not only looking at return on capital, the funder is also looking at return of capital. Because most angel investors or venture capitalists, they also have, this question in the mind, what will happen if the startup goes bust?
Right.
So in their mind, they are looking at founders who have got this greater ability to say, am I ready to grow? If they are ready to grow, then I think your question here, how can startups determine, how much funding they need begins. Now, how much funding is required begins with this growth philosophy. And therefore, the startups need to come up with a proper business plan, which basically tells them how much money is required for how long, what we call as runway. What is a runway? A runway is nothing but the number of months or the period for which the money would last. Most startups, they want to raise money for 12 months or 15 months, or let's say even, 24 months, depending on, how long they want the money, to last with them. Therefore, how do you determine the money? You have to prepare a business plan so that this money is required, towards hiring people, this, towards technology. This portion I need, probably towards working capital. This portion, maybe I need, towards applying for my IPR. Maybe this portion is towards CapEx. It should come from the business plan. When will it come from the business plan? Only when you have growth as an ideology in the mind.
So can I consider 5 years term of this period for the funding as an early startup? Because 5 years is a subsequent time or sufficient time where we make some business out of it or we make profit out of it, right?
Typically, what we say is, like you need to have a short to medium term plan and not a long term plan as you're going for a fundraise. Reason being, the scaling has to be consistent with growth. For example, if you're raising money for the next 12 months, you will have a milestone in terms of this money can lead to what growth. So everything is milestone driven, because when it comes to the world of funding, the previous question that you asked me, I use the term venture capital. Now, venture capital can be classified as micro venture capital, who are the capable to probably put anywhere between 1 to 5 crore. Then you have got early stage venture capital, who may put anywhere between 5 crore to even 15 crore. You have got then growth stage venture capital, who may be putting money from 15 crore to even close to 50, 60 crore. And then you have got the late stage venture capital. On top of it, you have got the private equity. So when you're raising the money, the focus is in terms of how long do I want this money to last and for what milestone. For example, from a 1 lakh turnover per month, can I go to something like a 6 lakh turnover per month in the next 7 months? And therefore, in the next 12 months, can it become a 8 lakh per month? These milestones are very important.
Rather than revenue milestone, can it also be like a marketing or branding milestone for those money which I get?
So what happens is that the utilization of the money is basically towards growth. Why am I raising the money towards marketing? Why am I raising money towards sales promotion? Only for the growth. So this money is actually linked to the growth. So in the world of startup, it's fascinating to realize that we have a number of unicorns in this country, but you'll be surprised. Hardly few unicorns are profitable. Most of them are still bleeding money, but you look at the growth. The growth is phenomenal. Oyo has just declared, that they are profitable. Until then, they were going. What I'm trying to tell you is that there is a definition for startup. A startup is defined as a company that can grow quickly. That's the only bigger mantra. Therefore, the growth capital is required towards ensuring that your turnover grows. Of course, let's say in the next 4 or 5 years, you have to ensure that you're able to break even, you're able to make profits. But in the initial years, the journey is all about growth. It's called scale.
Okay. Great, sir. Great understanding. And okay, the most important question. Everybody creates pitch deck to attract investors or to reach out to investors. And there are multiple consulting companies also available in the market who say that we make good pitch deck to attract investors. So what is the 3 most important to add in the pitch deck? Just give me top 3, which needs to be added in the pitch deck, which attracts investors, or investor looks only these 3 in the pitch deck.
Very first is the problem, sir. Am I defining the problem clearly? Because I always say that if the problem is not large, your market size will not be large. Why is an investor coming in? The investor is coming in because you're able to tell the investor that there is a sizable market which I can capture over a period of time, which means my revenues can scale up significantly over a period of time. That is what we want to hear. So the first is, are you able to communicate the problem clearly? What I mean by problem? The problem is basically what issue the customer is facing. What is the pain point that the customer has? That's why we always say that the startup is a painkiller. There is a higher chance for the startup to get funded. If a startup is a vitamin or a candy, it may not even get the funding. What is painkiller? There is a real problem that I have, and that needs to be solved. What is a vitamin? It only adds to my vigor. What is a candy? It is nice to have. So we always say that if you're able to attack the problem, then I think, you're able to come up with your startup idea much more better. Now, when I say problem, what I'm trying to convey, if the problem is popular, if the problem is urgent, if the problem is frequent, if the problem is growing, if the problem is mandatory, if the problem is expensive, trust me, this is where the startups can come up with more customers also. If the problem is itself is very small, chota mota, rumba chinnadu, nobody's going to get excited about it at all. It has to be popular, expensive, mandatory, growing, urgent, frequent. Then I think there is a significant chance for having a sizable customers also, because the market size will be big. So the first is the problem. You have to go deeper to analyze and explain to the investor how well you have understood the problem and therefore what solution you're coming up with. Then explain the next step as a market. So we have heard of this terms TAM, SAM, SOM in the marketing world, the targetable addressable market, the serviceable available market, the serviceable obtainable market. The last one is important. The serviceable obtainable market has at least to be 1,000 crore. 1,000 crore, if it's not even 1,000 crore, at least 800, 900 crore, thinking must be there. It must be as big as that. Why? Because only when the SOM is as sizable as 800 to 1,000 crore, then only whatever turnover you can get in the next 3 to 5 years can at least be some 50, 60, 100, 120 crore, which means you're able to capture, the size of that SOM, okay, really well. This is where the startup world speak about 10x.
Okay.
Why, the growth should be 10x. So the second important aspect is the market, which the startups, should really, really explain well. The third is the team, sir. I always say that the teamwork makes the dream work. Therefore, it's the quality of the team, how cohesive the team is, what's the domain knowledge, how well they will be able to face the competition, how well they're able to also ensure that they're able to show the scale, which is, something, which we can understand easily rather than just being a hockey stick, which means, is it a legitimate business plan? Is it a believable business plan? Because in the world of Excel, you can put whatever numbers and can show, greater growth. But the question is it authentic? That's what now we are looking from the team. So 3, problem, market, team.
Yeah, the third problem which you tell team is where I have another question subsequent to that. Like, see, I have an idea. I'm a only founder. I don't have a co-founder or anybody. I have a market idea. I'm a marketing guy, but I don't have any technical guy who implements that. So probably I can hire once you give the money out of it. So if in these conditions, how do you evaluate a team? There is only one guy with a small idea or big idea, and he wants to flourish in the market. So how do you evaluate? So you want to have a complete team on board, or if any one or two guy is enough for you to validate?
So this is where whom do you want to reach out as an investor comes as a big question. For example, if you approach the venture capital, they will not show the interest on a solopreneur.
Solopreneur.
So single founder is called solopreneur. They will not show interest unless the solopreneur has already created second in line command. Where there is proper ESOP, all that given. So whom do you approach as an investor? You can approach angels. Angels, would be happy to even give their support if they have the time to ensure that they can even double up as a co-founder if it is required.
Okay.
So it depends on whom we are reaching. For example, if you go to accelerator or let's say an incubator also, probably you may find fellow founders who may be also willing to come and support if there is a commonness of the business.
Right.
So it depends on whom I am reaching for funding. That's the important aspect to be noted rather than simply reaching an investor. I always say that do your homework very well before you approach the investor. Do you know where the investor is investing? Do you know what all investments the investor has done? Do you know the exits that the investor has had? Where can you approach the investor? Which forums the investor is going to? Is the investor going as a jury? Can you also understand what sort of questions the investor is asking? All this is something big homework that the founder has to do because fundraise is a very tiring exercise. In the papers, it's nice to see, 10 million, 1 million, 20 million, 5 million, all that raised. But trust me, it's a very tiring exercise.
Great, sir. Sir, and we also have multiple incubators whom we get incubated at the early stage and the accelerator. And I also find some of the third party or the private fund consultants who help startup in creating the pitch deck, the financial modeling, and reach out to multiple investors on their board. So how do these three work? So really the fund consultant plays they get commission out of getting the fund out of they secure in the market. So how do these really work? Can we really trust those guys and go about it?
I think, if you have to approach, first of all, a consultant or let's say an accelerator or incubator, I think, again, the homework is very important in terms of what is, the capability of that person or the incubator or accelerator, what sort of, startups, that are there in the incubator accelerator, what sort of success rate, the consultant has had in terms of raising the money. Do they have a website? Have they put, some of the names of the startup which they have funded? All that is very, very relevant. But if you ask me, are they valuable? I think the answer is yes. Why? Because, for example, if you look at a consultant, incubator, accelerator, because they have been in that business, been in that field, they can even give access to, quality mentors. They themselves, can give some good guidance. I think mentorship is very, very important for a startup because it's very lonely world. For entrepreneurs, it's very, very lonely unless, they're able to have some good, co-founders whom they know for quite some time. And therefore, they have a shoulder to cry on. So I think I always say that, no, sometimes you need an accelerator, incubator, or even, let's say, good consultants even to have mentorship. The second is networking. If you go to incubator accelerator, they also conduct a lot of events. They also have a lot of mentors or advisors. So I think the opportunity network is significant. If you go to incubator accelerator, they also give you the space, which means some of the infrastructure cost, is already, done in such a way that you don't have to, think of, more money to spend there, because it's already discounted in a big way. If you go to, accelerator incubators or even these consultants, because they are connected with the world of the funding community, there are higher chance for a potential investment, that can happen. So I think if you look from the ability for these guys to support you, I think the answer is a yes. The only question is, as a startup founder, have I done enough validation to understand their credibility? Because that is where, I think the game becomes much more interesting. But the truth is, because they are in the business, they can definitely support.
I got it. So if you said about the networking, so should I have, how long I should build a relationship with the investors to trust them, or for them to trust me, or for me to raise fund with them? So do I have any minimum networking period where minimum of 6 months or 1 year I need to be very close with the venture capital or the angel investor, so that they trust what I'm doing it, so that they believe on investing on me? So do we have any, or any fresher can get the money immediately? Is that possible?
My answer is slightly different, Mr. Anandan. Networking is an art, because what happens is it's very intuitive. Like, for example, you and me, how do we relate to each other is very, very intuitive. So probably I would have seen, certain aspects of you which I would have liked. You would have seen certain aspects of me which you would have liked. What I'm saying is that I think the very important statement is we are not looking for perfection. Because if we look for perfection in the world of networking, we will never, get it right. What is important is, am I getting the A, B, C that I require, which is very fundamental for my startup in terms of either mentorship or funding or the ability for the person to even connect me to the customers, or maybe the supply chain or technology or whatever, other resource I want or synergy I want. I think that happens, based on the intuitive feeling that you have and the research. Do your validation, go through, their website, or Google them out, or find out with whom they are connected. Go to LinkedIn and find out. But it's very intuitive. I think it is not the number of times we meet. It's the confidence that we are building about the person, which is very intuitive and very clear that I want A, B, C. Don't have too much of expectations. Because when we have too much of expectations, that also, lowers down, our results. I think it's very intuitive. It's an art. And I think many of us are able to do it very easily. Trust me.
Great. See, as you told, the angel investors and venture capitals, two different investment area, right? So you already told, if I'm a single founder or like a solopreneur, approach angel investors, and if it is if we have a team of good vision, then we have to approach venture capitalists. So is there any other criteria where we need to differentiate these two people, angel investors and venture capitalists?
Oh, there are a lot of differences, Anandan sir. Because I've been an angel myself, and now I run a fund. Okay, let me quickly share the differences. First is the ticket size. See, as an angel, probably I was putting monies like 1 lakh, 2 lakh, 5 lakh, 10 lakh, maybe maximum 20 lakh. Beyond that, it's very difficult for an angel to think of putting larger money. There are exceptions. Okay, but typically, if you take the angel crowd, the typical size is 1 crore to 20 lakhs. Okay, sorry, 1 lakh to 20 lakhs. That's what they do. Look at venture capital. Venture capital is an institution. They have already raised money, from different institutions, banks, individuals. So they are sitting on a pot. So let's say, that's, for example, the fund I run is a 50 crore minimum. It can go up to 100 crore. Okay, that's the fund. So if I have a 50 crore sitting in my pot, okay, the level of investment that I will think itself will be like a 2-3 crore minimum. Minimum 2-3 crore. I'll go up to a 5-6 crore also, but minimum. So first is the size of the investment, the ticket size. The second is the ability for them to micromanage. See, as an angel investor, because I'm also busy with my own world. For example, when I became an angel investor, I was working for a corporate. Now, I'm an entrepreneur. There is a limitation in terms of how much time, I can spend. So probably I may not be interested in a board seat also. But a venture capital would have the preference for a board seat, so that, they get to know what's happening with the startup. They'll be more closer, in terms of some of the decision making. So there is a difference even in terms of how they operate. The third is in terms of the role itself to be played. Angel investors are typically quite passive. Very few are very, very active. Most of them are passive. Okay, because they will touch base with the startup when it is required, for them. They're not regularly. But venture capital is not like that. Their role is active, which means, like if they're going for the next fundraise, they would want to understand who is this, new investor, what are the rights, it should be the same agreement or the same rights. So much of questions, that happen. Let's come to the sort of portfolio benefit. As angel investors, I can't give a portfolio benefit. What is portfolio benefit? When a venture capital is investing in a startup, they'll always look at what synergies my other investee companies can have. For example, I want to imply, so if I want to support a supply chain tech company. If I have a logistics company, I'll always think, whether the supply chain tech company can give synergy to my logistics company where I've invested. So the portfolio is something, that is always, very, very important in the mind. Finally, the exit strategy. If you ask me, angel investors, yes, they want exit, but they will not be literally behind the startup to get the exit, but venture capitalists will definitely have an exit strategy. They want an exit which is very, very clear because they've raised money from outside people, and they want to ensure, that they are able to give the exit because that is where their credibility also comes out. These are some of the differences, between the angels and the VCs.
So subsequent to your answer, I have another question about the fund creation. So do we have any website or the SEBI or anything, any website where we see details about the fund, how much fund is there? So you will also have a target of spending this fund and making money out of it, right? So do we have any list of funds available anywhere, which company, which fund, how much fund, all those, and which sector they are planning to it, so that it will be easy for us to approach the right VC?
So in the SEBI website, you will always have how many venture capital firms are registered with SEBI. For example, if you ask me, it's more than 1,100.
Okay.
So in the SEBI website, you will see you see my fund name, which is called Peaceful Progress. And you will see, what is the address of this company, what is the email ID. You will only see that, probably the website, Right. Once you have seen the name, then you have to Google on that name of the fund, go to their website. In the website of the fund, for example, in my website, you will clearly see, where we want to invest, what's our ticket size, what is the segments that we are interested, where already we have invested, and then FAQs.
Okay.
This is something which is common across most of the venture capital funds or even say private equity funds. You will see a proper website and you will see all that who is the people who are managing the fund. All those details, you'll be able to see.
Great, sir. So you might have seen or you might have rejected some of the startups who's asking fund reaching out to you. So you would have seen some top 3 mistakes which they would have done. So which you identified and how those can be avoided? Any top 3 which you want to notify here so that the startups here in our webinar can probably address those?
So let me first admit we have rejected many startups. Because the reason being, there are certain criteria that every fund follows. For example, in our case, again, we are very, very founder, dependent. We always say that we bet on the jockey, not on the horse. So for us, the founder market is very important. For us, understanding of the market size and competition is very, very important. When we say competition, we also say indirect competition. Don't just focus on the direct competition. And for us, the traction is very important. However, whichever way you show, that's okay. But we still want to see the traction because we always say that if you can't measure, you can't manage. So the first thing is that definitely most funds, they have their criteria. They go deeper. So if you ask me what are the 3 mistakes, I think the first, which the founder should not do, is they should always give us the confidence that they have focus. What I mean by that is when they sort of depict in their answers or in the way, they sort of provide information to us, we see that there is a lack of focus. They're trying to do too much. That creates a lot of, discomfort in us. So we always say that it is not about the ideas. It is about making the ideas happen. Because every time the founder thinks, I've got now, this new idea. So let me, start, adding this. See, it sounds exciting, but there is no guarantee, that the idea can succeed. So we always say that it is never about the ideas. It's about the making that idea work is very important. So we are looking for achievers. And if you ask, who are those achievers, the top achievers, they simply do not copy. They simply do not compete. What they do? They simply dominate. They set their own pace. This is the sort of, founders, that we're looking. So the first thing is lack of focus, trying to do too much is a big, big, big no for us. The second, which is very important, is we want to understand what sort of feedback they are constantly getting from the customers. so that they are able to ensure that the feedback is implemented in their product or service so that they're able to do a much better job. Now, if you see that they're neglecting the feedback, not purposely, because again, they're doing too many things, or they're busy with some other thing, or they're trying to reinvent something. This is where again we get literally unhappy with the founders, because we say that the most unhappy customers are the greatest source of learning. If they're unhappy, go behind them to even understand what can you learn from them, because the moment you take the feedback, you can become a better startup. So that's the second. The third, which is very, very important, is ignoring the market dynamics and the competition. See, most startups say, I don't have competition, or I am above the competition. That's never true. We have always seen that there is indirect competition if there is no direct competition. So one of the requests that we always make to the startup founders is, don't get into this lack of insight of understanding who all others are there. Always have this insight to know who are there. Conduct a thorough understanding of who is around you. Stay agile, because if we don't understand the market dynamics, there are higher chances that somebody can win over us. We always say that be aware of the fact that there is competition behind, because competition helps you to become better. It helps you to be ahead of the race.
Great, great. Good thoughts. And sir, any other alternate way of raising funds, like crowdfunding, revenue-based financing, so which maybe not like the fund directly from the venture capitalists or angel investors. So any other opportunities other than the normal standard way of raising funds?
So they sound exciting, but they have got their own limitations. For example, you took the name of crowdfunding. Now, what is crowdfunding? Crowdfunding is, there are certain websites, where you can go and then put up your idea, and then you can raise money from those who are interested. Now, typically this crowdfunding may even has as a low amount as 1,000 rupees to maybe going up to a lakh or a 2 lakh. Now, just imagine if you have some 100 people, 200 people, putting small monies, what will happen to the cap table, the shareholding pattern itself? So one excitement is to say that I'm raising the money, because these guys are only putting small money. It will not matter, even if, let's say, there is some issue with the startup.
Right.
But the problem is you have too many people in the cap table. You want to raise the next money, it becomes so difficult, because unfortunately you need the signatures. Yes. Because it is all driven by the Companies Act, because startup means private limited. What is private limited? Companies Act. So I'm just giving an example of crowdfunding. You took the name of revenue-based financing. Revenue-based financing is interesting for a business which has got consistent monthly revenues, which is coming automatically. For example, like a D2C business, direct to consumer, or a SaaS business, where you're getting the money, regularly. You don't have to do anything. No follow-ups, because that's how, the arrangement is. It's either auto debit or, it's structured that way. If that is the case, at least, you're able to get the money regularly, and therefore your revenue-based financing works well. But what is the problem of revenue-based financing? It's a high cost. It doesn't come cheap. So revenue-based financing has got its high cost. So a lot of people can resort to revenue-based financing only when their gross margins are high, so that this interest cost will not hit the bottom line significantly. You'll still have a decent profit before tax.
Right, sir. Just reminding me about the crowdfunding, the Reliance, when they came to IPO. Maybe they also bought even 10 rupees. I read somewhere in the movies and in the article that there were more shareholders in the Reliance, and that was the only company who issued share at 10 rupees and invited more shareholders. So it's also like crowdfunding, right? So where more people have invested on Reliance.
So if you look at whom they have approached the big ticket size. Don't go by the 10 rupees share value. Go by the big ticket size. For example, the recent situation of how Reliance got saved. They had significant debt. They were able to leverage Jio, and therefore they were able to get significant money from even investors like Goldman Sachs, and the best of the investors. But what happens is that a company like Reliance can have the ability to raise significant checks from investors. So when we say crowdfunding, the meaning is very simple. You're just approaching anybody and everybody. But that doesn't mean that if you start raising smaller monies, you'll be able to cope up with the shareholding pattern or the cap table. You need to know from whom you're raising the money. When does crowdfunding succeed? I can give you a couple of examples. Let's say you have a project, which is like a social project. I think there will be a greater sense for a crowdfunding to come, because you can create a special purpose vehicle and ensure that for that particular project you can raise the money, and not for the startup in general. The second example is, let's say there is a situation where you want to do a specific medical support. I think you can go for crowdfunding and get that money. But for a startup going for crowdfunding, I wouldn't advise typically. I'll give you the reason why. One Crowd, where I'm an investor, initially started as a crowdfunding. That's why the name is called One Crowd. Today, they have no more crowdfunding. They stopped it long time back. They are now a fund, because they also realized, oh my goodness, it's such a hassle, to do this exercise. And therefore, in the world of startup, crowdfunding is not very popular. It is still around, but not very popular. What is popular, let me tell you, as an alternate fund? I think what is popular is a strategic partnership that you can have with the corporates, or let's say even corporate sponsorship. For example, if your company is aligned with the objectives of a particular corporate, some of the CSR money or some of the money that they're willing to invest in the startup is also possible. Why? Right. One is because they are very keen to ensure that there could be co-marketing initiatives. They are very keen to tie up with the startup so that there is much more ability for them to use the synergy of the startup to explain their own business model. So this is where you exploit the strength of the startup, but because you have the money power, you're able to go together in that journey.
Right. Great, sir. Sir, and one more thing, in terms of, I also heard that many investors invest and they take complete control of the company as a board member. So how do we actually negotiate with the investors in terms of the equity and the control which they generally ask for?
So the negotiation with the investors is, something which the founders and the startup entrepreneurs need to be very cautious about. Why am I saying cautious about? I think when the investor wants to invest, let's say a venture capital, they already give a term sheet. Okay. And the term sheet itself has got the various terms in which they want to come in. Therefore, the founder should go through each of those relevant terms, understand what is the implication even before signing it. Because if they don't understand, because they're only looking for money and they say, okay, we will see it later, that later will be harmful. Therefore, one of the big requests, that I have for the founders, the entrepreneurs is, if you're getting a term sheet from a fund, ensure that you have gone through the term sheet properly before you ink it. Because what is the investor, expecting? The investor is expecting certain sizable equity portion, so that they also have certain control. Now, what is the sizable? Trust me, it can be as low as a 15%, could be as high as a 25 to 30% also. Most venture capital firms are not going beyond 30%. So I think there are three messages I want to give to the founders. One is, please understand which investor you want, which is very, very important. Second is, be ready to compromise where you need to compromise. I always say that 20% of aspects of life is only important. 80% is not important. Those 80% are trivial and small, you can compromise. 20% never compromise. And the third I always say is that be careful to leave something on the table for the investor, so that the investor gets excited, because this is where the trust gets built. The most important thing of getting an investor into the startup world is building the trust, because the trust can do a lot of magic. Investors are investing because they want you to succeed. They're not investing because they simply want the control. They want a greater success so that the exit, when it happens, they can also claim, that look at the startup, how well, the startup has done. Fresh desk. The investors, who invested there, they're now, sitting on significant money. Same as the, case with Mama Earth. Mama Earth, again, including Shilpa Shetty, who invested. I think all investors, they want to ensure that the startup succeeds. Somewhere, if there is a dissonance or disagreement, it's because somewhere the trust is lost. Constantly ensure that the trust is built.
Great. Sir, before any investor invests, so what are the three key milestones which you look into a startup?
I think from my perspective, if you ask me what are the three, one is, please show the traction. Traction is movement. Traction is momentum.
Right.
Traction is, it can be even, done in a way, that you simply explain some of the key items that you're measuring, what we call as metrics. So it may not be perfect. So the first is traction. What is traction? Traction is showing some of the numbers, showing some of the qualitative efforts, that you're putting in the business to show how well you want to grow the business. That's number one. Second is As you're scaling up, ensure that you're able to build the team. Because if you can't build the team, the business cannot survive, later. The founder or the limited team cannot do everything. So please ensure, that there is a proper team so that there is functional responsibility, which is given to the team members, which is very, very important. And as I'm speaking about the team, the third important is how do you show the growth potential? Which means what is growth potential? How we are able to show even the monthly recurring revenue? How does that grow? In a geometric fashion, so that you're able to show that the next year the growth, is much more better than the previous year. But more importantly, as you're growing, you're also able to show that how well you're able to get more customers, how you're able to ensure that some of the key customers you're growing along with, and more importantly, if you're able to penetrate to some of the other segments, business segments or different geographies, that's where the investor gets a lot more confidence. So number one, traction. Number two, team. Number three, the growth potential. That's what you have to be very focused on.
Okay. And okay, the most important question of the session is, say there are more new technology or new sector is evolving. Like one we deal is on the political tech, where election tech, gov tech, and civic tech, we work on it. Maybe before that, the EVs tech means the electric vehicle sector is also new once it evolved. And the same fashion is what we are into now, political tech. So how do investors validate the new emerging sector? So do they wait for people to invest and they get succeed, or they take some early bird risk and in evaluating the new technology platform?
It is always early stage risk. There is no doubt in that, because always investors are looking for something which is new. What is the newness? What is the disruption? You took the name of electric vehicle, so let's go to EV. EV is still very new for this country. Probably, 7-8 years old. That's what EV is all about. So when the initial investment started happening in the EV, there were investors who were willing to take the bet that this segment is important because there is so much of talk which is happening about sustainability, about renewable energy, about, the carbon credits, about becoming, absolutely, zero carbon. I think all those talks is very, very relevant, from an environment angle, from a country angle, from the global situation itself. So I think there are parameters which make you understand that this segment can grow because there's a lot of noise that is happening in the segment. And investors are always keen to invest in early stage, startups where there's a significant risk, but they know that if the risk, is well managed, there's a significant reward. We always, use this risk-reward equation. Higher the risk, higher the reward. So you spoke about the political tech. Okay, let's quickly understand the political tech. Oh, there are already startups, who are there, whether it's a civic tech or whether it's a, gov tech or whether it's even the election tech. For example, I have come across a startup which is simply called as Civis. That's the name of the startup. This startup is Mumbai-based.
Okay.
This startup is basically bridging the citizens of this nation with the policymakers.
Right.
What they try to do it, whatever is a proposed government policy or the existing policy, can I give the authority to the citizens to come up, with their thought process on what they feel about the policy? What an interesting idea. I'll give you another example because we spoke about election. There's a Bangalore-based company called Next Election.
Right.
And the whole idea of this company is to ensure that they're able to use technology so that they can understand the political campaigns better. And once they've understood the political campaigns better, they want to bring the consumer sentiment into it. What the consumer sentiment is all about. Right. So what I'm trying to tell you is that, there are startups. For example, I remember from IIT Madras, there's a company called Hyperverge, which I also, worked with them. It's an IIT Madras startup. This is an AI-based startup, which is only focused on the identity verification. I think in the world of tomorrow, we need not go for elections. If our identity is properly verified and we have an app or something, we can, even put our votes. So trust me, there is significant change, that is happening in new age sort of startups. There are investors who are taking risk because I took this name in the world of Hyperverge, which is an interesting startup. You have got funds like, you'll be surprised. New Enterprise Alliance. That's a fund, which has invested in them. There's a fund called Naya Ventures, which has invested in them. What I'm saying is that investments do happen in very, very early stage risk-taking startups.
Okay. Okay. So in early stage, just to understand the word early stage is basically at idea stage or at a traction stage.
So there is, you have to break it, because in early, you can call it as a pre-revenue stage.
Okay.
You can break it further as a pre-seed, a seed stage. A pre-seed is just an idea. You don't even have the POC or anything, of that sort to even tell what it is. The seed stage is where you have raised the money to show, can I show an alpha version, a beta version, a POC or an MVP, so that I can go to the revenue stage.
So pre-stage, seed stage, and then the
Pre-seed, seed stage, and then, you get to the revenue stage.
Okay. And I also heard it's very difficult to get fund from investors and satisfying them. As you said, the confidence we need to build. Many founders are struggling going each and every event, VCs, AIs, and even the Chennai Angels, Mumbai Angels kind of consortium. People are going, and we generally hear the information that it's very difficult for them to satisfy or get the confidence, and they don't generally fund it, and it's all waste of time, and they just call us and they don't fund us. So these are the negative images circulating into the world, in the society. So so is that how difficult it is to get money from investors?
So, Mr. Anandan, because I'm also an entrepreneur and I'm also in the business of fundraise, what I basically look at the startup before raising the money for them is, how should I connect the right investor to them? Which means I do the homework on the investor to even understand whether this investor will be relevant to that startup. Because if I simply spray and then pray, nothing will happen. And then, all the statement will come. Investors are not investing. They're simply asking questions. They don't even, have any, sort of respect for it. Oh, this will keep happening.
Right.
I think what I'm trying to tell you is that, the homework that, the startup founders need to do is very, very important. I always say jokingly, in the word fundraising, there are two I's. Fundraising, two I's are there. There's letter I. Right. I always say that should never stand for imitation. You simply don't imitate some other idea. It should never stand for irritation. Because fundraise is the most difficult exercise. In fact, it should stand for inspiration and innovation. How do I inspire the funder to say, boss, if you don't fund me today, you're going to be the loser? How do I inspire the investor to say that, look at me, I'm highly innovative. You're going to get the greatest value by putting money into me. I think it's a job of the startup founders, even to tell the investor that they will miss the bus if they're not part of the journey.
Great, sir. Great statement. Inspirations and innovations. Great,
yes.
Great thought. Sir, actually, just like EV and the real estate is also one of the sector which was booming earlier. And I actually want to compare rather than EV and politics, I just want to compare the real estate and political tech or election tech, the industry, right? So both have the same kind of analogy in the industry perspective. So how do investors evaluated initially when the real estate industry boomed? And even now people are investing it, and some investors stay away from real estate also because of the documentations or the misproportion which is happening in real estate. But still, how do you evaluate those kind of stuff? Just compare me and give me some statement like real estate and political tech. How do we see both?
I think, let's understand what are the pitfalls, in terms of real estate, or let's say even the political situation, therefore the political tech. I think one is, if you take the real estate world, there's a lack of transparency.
Right.
Sometimes you don't know, what is the real price. Therefore, the prop tech came, where the information was published, so that people get to know, what is FSI, and therefore, what is the rate, which is as per the government norms, what is the rate that is being asked in the market. I think the first is the transparency, which is very, very important, even from a political tech angle. Because if you say I'm a gov tech, I'm a civic tech, or I'm an election tech, the only question is how sturdy is the security, in terms of what you're offering. How sturdy, is the transparent mechanism in which, it is operating. So that's the first. Second is, I think if you take the real estate, I've always felt, that there's always delays in the property handover. And I think, wherever you want to put money, okay, even if somebody says this is the project timeline, there's always been a delay. What happens is that the delay basically makes you think, when is my return going to start then? And therefore, what you have to do is that there's a lack of data, there are delays, there's a lack of transparency in terms of how it works. More importantly, if you look at the real estate world, in the world of real estate, one of the bigger issues that I personally I have faced myself, is, trust me, there is a fragmented market. When there is a fragmented market, it always creates issue. For example, you spoke about political tech. Now, again, the political tech, the question comes, which party am I endorsing? In a state, and therefore in a council, and therefore in a municipality, how do I look at it? So if there is transparency, if there is a way that it is much more structured, then I think there are higher chances for real estate investment or political tech investment to happen. Now let's speak about real estate investment. What change has come there? One of the biggest change that has come is through SEBI. SEBI has come up with something called REIT, which is Real Estate Investment Trust. By creating a institution called REIT, they made things much more transparent. They made things much more robust in terms of the accountability for the person who is running that real estate. Now, what SEBI has done is very, very recently, because there are the small and medium, real estate companies also, they have come up with something called SM REIT, which is your Real Estate Investment Trust. In this SM REIT, they have made people like you and me to invest as low as 10 lakhs as a fractional investment into real estate. For example, we would have seen some nice property, but we can't own it. But we can be fractional owners. Right. That can happen. Right. Our idea of real estate investment sometimes is only the yield, the return. We are not, investing because we want to stay there. I think what SEBI has done is so beautiful. I'm pretty sure there is going to be a government, mechanism to ensure that it happens in the world of political tech. As I said, there are already techs, which are there in election, in the civic, in the government. It's all growing only, and investors are investing. Not every investor again, because even in the real estate world, there are specific investors. I'm pretty sure even in the world of, political tech, there'll be specific investors. But I think the game has started. The journey has started. And I think it's only a matter of time, when the other investors will start, finding the comfort of investing there.
Right. Just like selling the shares of a company, now people are selling the square feet of a building. Right?
Exactly.
Right. Very good, sir. And let's go to the chat section. So we have one question from Lakshmikant saying that, is it possible to get a mentoring from Mr. Chandrasekhar? How do people?
Definitely. Please reach out. Please reach out to me on LinkedIn. In fact, Mr. Anandan has got my details. You can even reach out to him, and more than happy to give the support.
Right. I'll share the email ID of the Chandrasekhar sir, and you can reach out Lakshmikant.
Definitely.
And we have one question from Gokula Christian saying that startup in jewelry and diamond and gems, export and domestic, the potential is more. So I think the jewelry industry is also growing now. So what is the say on that, sir?
I think from what I've seen in terms of CaratLane and Bluestone, I've been super excited. Because I used to understand jewelry more like an offline business, because I've seen the GRTs, I've seen in fact even the Tanishq in my mind is still an offline store, Right. But I think when CaratLane and Bluestone, they revolutionized by bringing in the online, and then making it much more easier for customers to have choices. I think that has made this industry significant. So if you ask me, a startup in the world of jewelry has to be focused in terms of what they want to sell. Okay, let them not sell anything and everything. Let them be focused. For example, precious stones is just a word that we can use. But within the precious stone, if let's say we're able to say that we are more focused on diamonds. Or let's say I'm more focused on platinum. Or let's say within the gold, I'm very focused on the subsegments of the gold. Maybe it's a necklace. Or maybe it's just a stud. I don't know. If it is silver, I'm only focused on the silverware, which is meant for ABC. Then I think the startup, makes a lot of focus, because for investors, less is more.
Okay.
The less you're doing gives us the confidence that you'll be much more focused in delivering the results. And I always have felt that where your focus goes, your energy flows. So if that is the case, then I think the segment could be brilliant.
Okay. And another question is directly to you, saying that will your company, the Peaceful Progress, invest in affordable housing and AA agent for home automations? So do you have any sector-specific investments, or are you open to any sectors?
So that's a very good question. We are sector-specific, but let me define what sector-specific we are. We are technology. Wherever there's a technology, we're happy to invest. We are invested in consumer business. We are invested in mobility. What is mobility? Or electric vehicle, drone, and then space technology. So the question itself says that they are going to use AI agent, which means technology is going to come in. So Mr. Humayun, if your startup idea is affordable housing with the technology, definitely becomes a prop tech for us. And therefore, I will be happy, to consider, evaluate, and then, if everything goes well, happy to invest also.
Probably you can contact him. I'll share the email. Sir, probably you can drop your email ID in the chat,
yes,
so
let me do
that people can directly reach out to you and through email. And I'll share the LinkedIn link of Chandrasekhar Kukari in the community forum community aspect, so that you guys can directly reach out. Yeah. And
thank you, Humayun. Thank you. Yeah.
Sure, sir. Thank you. Thank you very much. And I think it's time to wrap up now. And thanks for your valuable time during this Ayudha Puja and Dashara time. I see many participants have been not joining because of maybe the festival season, but somehow we had a good participant of almost 25 plus in the team. So thank you, sir. Thank you very much for your great presence during this.
Thanks to Anandan, sir. I'm so happy we did this on a Vijayalakshmi day. So I should, thank you. I should thank all, those who have joined today. Wishing each one of you the very best, as well as, happiest festival greetings. Thank you once again, Anandan.
Thank you. Thank you. Thank you very much. Thank
Bye
you.
for now. Bye.